the introduction to infinite banking. I'm going to try and keep this presentation brief and under an hour for sure, and some Q&A at the end. Some of you guys are more experienced with infinite banking and looking to implement maybe the new accredited investor banking. Some of you guys are brand new. We're going to start off with a refresher. Of course, everything here needs to be personalized to your personal situation, which also includes the actual configuration of the policies. You can get a life insurance policy from pretty much all the major companies out there, but the devil's in the details how you configure this stuff. I'm not giving any financial advice. I'm not a certified financial planner, nor am I licensed to do these policies. I'm just telling it from how I do it. If you guys need a referral to the folks that do it for our community members, please let us know, team@thewealthelevator.com, or with any vendor that you guys need, thewealthelevator.com/vendor is the URL. What I've discovered just through my own journey and what I talk about in the book, The Wealth Elevator, is three major parts of this, which is investing in alternative investments. That includes real estate, private equity, rental properties, and then the tax strategies. And then the third part is the infinite banking, where you're making money in a couple of places. And the question that comes up, what do people do with their short-term or mid-term savings when they're letting it build up to get to a substantial amount, $50,000, $100,000 to put into a larger deal or go buy a real estate asset? This is what I've discovered talking to so many accredited investors as a best practice, what a lot of people are doing in that intermediate time. And then also long-term in the future, like when you're out of the growth mode and wanted to put your money more into savings mode, but still generate a return. Right now, the problem with putting your money in 401ks and IRAs is the liquidity there. And on the other side, you've got your money in the bank where you hardly get any interest and you're getting beat by inflation. You have to have your money working, either in investments or something that's beating in the pace of inflation. Essentially, the idea is you're double dipping and you're making money in a couple of places. And in a way, you're replacing the bank, which is making money off of your money. I think we all generally understand that the bank takes in deposits and then they go and invest the money. A lot of times they'll invest in apartment buildings or real estate or other investments out there, or they'll lend it out to local business owners and operators, and they'll make a higher return, and their business is making money off of the spread, and they make a great yield off of that. So by implementing infinite banking strategy, you're essentially getting rid of the middleman and becoming your own bank. Also, part of that is getting part of that yield back. What it's based off of is a whole life policy. Life insurance, you've got two kinds of policies out there. You have the whole life and term life. No, not a certified financial planner. Term life, I think, is something everybody should have, where if you passed away, at least to pay for funeral expenses and close up loose ends. Now, I think most of us in our community who are accredited investors, you probably want to have maybe a 7-figure, high 6-figure type of policy that gets cashed out to give to your kids, your family upon your passing. Some people say, I'll be dead, so it doesn't really matter. But to leave this earth and leave your loved ones behind, money to help things, maybe not the grieving process, but helps them carry on the life, at least make up for the fact that you're not making income, which is what these policies are based off, your earning potential. On the other side of it is the whole life policies, which is what these infinite banking, accredited investor banking policies are based off of. Both kind of do the same thing, right? There's like a payout scheme upon your passing. And again, a lot of this talk is a little morbid, but this is what you're basically doing, is using these life insurance policies as a hard asset. And that hard asset is a life insurance contract that has a cash value policy. The nice thing is when you start to fatten up these whole life policies, you get the benefits of the term life policy too. So of course, talk to your own insurance provider on what threshold makes sense that you get rid of the term life, so you don't have to pay for two things that are doing the same thing. But by implementing this strategy, this is the secondary benefit of doing this. This is the big reasons why people are doing this. And when I first started to learn about this strategy, if you're somebody who gets bogged in the details, it can get a little confusing. But we'll start here on the upper left-hand corner. One of the benefits of using the whole life policies is it's a very stable policy where the premiums are guaranteed to remain the same, right? Doesn't matter if your ages change, changes in your health, which is again why it's important to get this stuff sooner rather than later. We have some folks over the last several years dragging their feet on this, just like the trusts and stuff, living trust, people tend to delay it. But your health ain't getting any better. The sooner you do this, the better. If anything, just your age. But also, that's what separates the whole life policies from there's other policies out there that are called IULs, Index Universal Life, which are fixed onto what's happening in the stock market or the economy. So the whole life is based primarily off of your health index and not really tied to what's happening in the stock market. You could configure these policies with a component that goes up and down with the stock market. Again, we can connect you with the agent if you want to do that. But just to keep things simple for today, we're just going to keep it all with using the whole life as the base to take the economy out of the equation here. Investments, they go up and down with the economy. They're market dependent as it is. To do it with the whole life takes that factor out of the equation. Upper right-hand corner, additional dividends. You can use dividends that you get from the policies to offset your future premiums in case you run low on liquidity in the future. It can be used to pay that so your policy doesn't cave in. And also put in additional money to buy up that additional insurance, or what we'll call paid up additions. And we'll define these terms a little bit later when we go into more detail. What this does is increases the cash value of the policy. Continuing on in the circle, tax-free loans and withdrawals. So this is kind of the reason why we do this, especially in the growth years, right? When you're under a few $1 million net worth and you're trying to grow your money in multiple places, invest in alternative investments. The idea is you put your money into a whole life policy and you take a loan from yourself and then put that money to work in an investment or a rental property. You can also use the cash value to do whatever you want, right? Remodel your kitchen, buy some jet skis. I wouldn't necessarily do that if you're not to the end game level of net worth, 4 to 5 million. But hey, that's you, right? The money is there to do what you want. And then the cool thing is while you have an outstanding loan out, your entire cash value continues to grow in the policy. The analogy, if you want to think about it like a home equity line of credit, you own your house. And then if you want to draw the value out of it, you can take a line of credit from it through a HELOC, home equity line of credit. And then you can use that for whatever you want, right? But then the house, the underlying asset continues to grow and you get that upside. Same thing here, just to easily digest it. Think of this as no different than a home equity line of credit to your house. Or in this case, instead of the house, the underlying asset is a life insurance contract that has a cash value. And when you take loans from it, it's like a HELOC. Additional benefit, as we said earlier, again, this is the secondary benefit. I don't want to have this come across as the big thing. You also do get a death benefit. And as long as your premiums are paid, your beneficiaries will receive the full life insurance benefit minus any outstanding loans. That's a big concern with people, right? People are like, I'm taking loans from this policy and I don't know when I'm going to die. And probably when I die, my pants are going to be down and I'm going to be caught. Nobody wants to die with their pants down. That's probably the worst position to ever be. But more than likely, if you don't know when you're going to pass away, you're probably going to have some outstanding loans on your policy because you're likely still in the growth stages. But no big deal, right? Whenever that unfortunate day happens, you minus any outstanding loans, and then the cash value goes to you tax-free. You can also talk to your agent about adding on a long-term care rider onto that too. And then the last thing here, you get the guaranteed cash value growth. And this is the one part of the double dipping strategy. So when you fund these policies, the cash value grows tax deferred. And then again, the premiums can be used for whatever you want. The way I've done it in the past is I use it to take a loan out from my own policy and use it to invest in investments. That's when you're in the growth years. When you get to more retirement age, you can just use it to pay it all off and have all your cash value there to pass it down to the next generation. Or you can simply withdraw on it very slowly and use it as retirement income. You can use it as education funds in lieu of a 5 net 29 plan with a lot less restrictions there. You can use it to pay off your mortgage. depends on where the interest rates are. Right now, interest rates are pretty high, and you're probably going to be paid a lower rate with your infinite banking policy. So it would make sense if you're just looking at it from a numbers perspective to pay off your high rate mortgage and just pay the interest on your infinite banking. Of course, every situation is different and these things move in flux, right? As interest rates go up and down, certain plays become more advantageous. And this is part of the whole alternative finance world out there where it's just not a one set thing. It is very much it depends strategy. And you'll see a lot of what we're talking about today is a lot of just the basics of people they use these policies and these strategies. They do some pretty cool stuff with these policies. You can also use it to establish an emergency fund. The cool thing about these policies is when it's in there, it's sort of asset protected depending on which state you're in. Very similar to 401k, very hard to get at from creditors and litigators. Personally, I'm a business owner, so it's a great place to store your payroll for your team and reserves, places that kind of store the cash you need in a rainy day. But you definitely don't want to put it in a bank where banks fail, at least the lower tier ones, and you get a pretty horrible rate of return in there. Here, you get much a better return, and it actually, a life insurance company with a AAA rated firm is a lot more stable when you look at bank failure rates. I will address this right now. We said the word whole life insurance. And if you follow Dave Ramsey or you're doing some Googling on whole life, there is a lot of people out there that will say whole life insurance is a scam, right? You should just buy term life and invest the difference. And this is a dissidence that I was like very confused in 2015, 16. I started to meet a lot of accredited investors and started to learn about these alternative investment strategies. And I was like, then why the heck are these very affluent people using these very large whole life insurance policies? And it didn't really occur to me that the whole thing was how these policies were configured. There's no difference between a whole life insurance policy that's configured with majority insurance versus how we like to do it with just 10% insurance. And then the other 90% is the paid up additions. That's the secret sauce. Most people, when you're talking in YouTube land or articles or tweets, you never get past the surface with this stuff and they just demonize whole life policies. So what I would say is whole life policies, yes, generally they're incredibly high fees, but the fees come from that insurance portion of it. And most times when people create these policies, it's with the majority of the policy that you put in as the insurance portion, again, where the premiums and the commissions come from. Now, when you crunch that all the way down to the minority share or like even 10%, you can see how that drastically reduces the fees. And you can also see why a lot of these agents don't like to configure the policies like this. And then now you get to in this kind of gray area where you're like, I want an infinite banking policy. There's a lot of shades of gray in there, right? There's a lot of people that do so-called infinite banking policies where the mix is 50% insurance and 50% paid up additions. And still, that may be 5 times as much commissions as the way that we like to configure it. I'm taking a quote from Dave Ramsey here. He says, working for these big mutual companies out there, they screw people every day. And they actually, the business model is they'll get like the young guy from college or high school to go out and call their old friends and sell them these small few $1,000 term life or whole life policies. And the whole life policies are, again, not how we're configuring it, right? The ones that these guys are doing are the ones with the high insurance component with the high commissions. The opposite of what we're trying to do with the bare minimum insurance and the ability to take loans from it, which a lot of those mutual companies do not give you that ability to do that, or it makes it a lot difficult with the fees in there. Maybe you can remember when you graduated college, your long lost classmate gives you a call, wants to have lunch and sells you on some life insurance policy. Yes, it's still whole life insurance, but it's all to do with the dosage of how much of it is insurance versus paid up additions. And when you configure it with very little insurance and 80, 90% paid up additions, that's where you crunch down the commissions and you keep more of it. But now you're configuring it how the big guys do it. Bank of America employ these types of strategies where they'll buy life insurance policies on their key employee. The Walmart does it with their key employees, Walt Disney, the Rockefellers, Rothschilds. A lot of these strategies are emulated by big family offices and companies. Again, using the same whole life insurance, but it's all predicated on the dosage. This comes down to working with the right agent who understands this and is willing to forego those commissions. But that's where I think our group is a little more sophisticated. We'll get into a policy illustration here a little bit to make you aware, or maybe if you have a policy currently, you could probably compare it pretty easily, or just submit it over to our team and then they can do a quick run for you. For some people, it makes sense to just scrap the policy. That's what actually I did with my spouse's one. But sometimes you can do like a 1031 exchange. You can exchange it and roll it into a properly designed policy. Maybe the word isn't improperly designed or badly designed, but it's what you're looking for. And when you are an investor and you're going to take the money out as a loan to invest in another place, so you can make money in two places, which is the policy generating a nice little return, and then your money is out working in a project, a syndication, a rental property, what have you, or even back in stocks. That's the idea where you're making money in two places. So for those of you guys who've heard the term infinite banking, at this point, it's a widely used term for the general use of whole life insurance. But again, it can be configured in different ways. This has been around, I believe, since the 1980s. Normally what happens are like the big family offices will use a strategy like this and they'll get it indoctrinated. And then it comes out to the more ultra high net worth, wealthy people out there. But even in the 1980s, 1990s, people have been doing this infinite banking here on the left side. And again, the real difference is the premium split. Whereas in this case, even if they do say, oh, it's infinite banking, it's just using a 50-50 premium split. What we like to do is crunch the premiums down even more to even 5 times as less to get the insurance portion just to 10%. So like a 90-10 or 10-90, depending how you're saying it. What this does is it stretches your dollar as much as possible, and it allows you to max overfund it even more. So again, I mentioned this earlier. If you're confused by this whole thing, don't feel bad. It is a little confusing. The best thing is to get around other investors who are actually doing these types of strategies. That's been my whole thing about investing and learning about these strategies. Like when I was first learning about this, I was like, this is confusing. But then I was like, then why are you guys all doing this? I don't get it. What works for a lot of people is they think of it like a house. But instead of a physical house, think of the house as a whole life insurance contract, which when you're talking big companies with very strong balance sheets that have been around, been paying since 100+ years, pretty stable companies to pay out the premiums. You think of it that as a hard asset. And when you're paying into the policy, you think of it like you're paying down your house mortgage, just like putting in your base premiums. That's like your mortgage payments every month. And that obviously you're building up equity that way too. But you can also do what's called paid up additions, PUAs, and that's paying extra payments to your mortgage. Again, what people will like to do is the insurance portion is maybe just a tenth of it, but the majority of it is these paid up additions. The idea is you're making these massive contributions to your life insurance contract to boost up the cash value portion. This maybe in a matter of a week or two, you can take the money back out through a loan, just like you would a HELOC on the house. And the money can go elsewhere to do what you want, ideally investing. The house is still yours, right? The life insurance contract is still yours. And that continues to grow along with where else you put the money. These are the two terms to key in on. There is one gotcha. There are limits on how much you can put into paid up additions. And this kind of is dictated by when you configure your policy up front, you got to come up with a plan with your agent. A lot of this is dictated by how much is your net worth, what is your net every year, your net meaning how much you make minus how much you save, right? You want to right size a policy for yourself so that you don't fall behind. Yet you want to create the way I call it bucket. You want to have a big bucket so that you can grow into comfortably. This is where by having a too small of a bucket, you limit to just how much you can fatten up your policy or do these paid up additions on your policy. The other thing here is I don't think I mentioned it yet, but these policies have great tax advantages towards it. When I finally understood this, I was like, oh, now I understand why the wealthy do this strategy. But basically, the way the IRS sees life insurance is when the money comes out of it, it's seen as tax free. At one time, people abused this. They would put $1 into the policy as insurance and $1,000 as the paid up additions. And it got to be a point where the IRS was like, wait a minute, guys, this is getting ridiculous. And they were like, all right, we got to put limits. So they started to create this MEC limit. And at this point, it's dictated by your age, gender, death benefit, but it's basically how much total funds you can contribute each year without the policy being considered a modified endowment contract. And at that point, you've crossed that threshold where it is tax. Luckily for all of us, these limits are pretty generous generally. You got to give it to those financial hackers out there. It's the real estate professional status. I don't know exactly when this was, maybe 10, 20 years ago, but it was a little loophole where a bunch of doctors would just buy one measly little rental property, and then now they would be like a real estate professional and then use all these real estate losses to lower their incredibly high doctor salary. And this is, again, where the IRS is like, all right, we see what y'all are doing here. We don't like it. You're abusing the system, which is why today you see all these kind of rules with the 750 hours and you have to have active participation in your portfolio. So they tried to close up these loopholes. Same thing here, right? People just got a little egregious without having any type of MEC limit there. So that's why this came into place. But this is where you work with an agent and you stay within bounds on these policies. But still, it's even as configured today, it's still pretty good place to store some capital and do this double dipping effect. So the big part of this whole strategy is to take the money that you get from your cash value, take a loan from it and get on the offense and invest into real estate deals, stocks, bonds, mutual funds, private equity, your own businesses. And you can also take it for your own personal expenses too, if you want. This is just merely, you can see this is a tool that you can use in multiple ways. Whatever you have out as a loan, ultimately, if you pass away, it gets recollateralized and minused out of your cash value at the end. So that's actually a pretty simple process. I've got a few of these policies, but what I'll do, and a lot of this is in our Infinite Banking e-course. If you guys aren't a member, you can get access to this at thewealthelevator.com/club. If you can't find the e-course, it's in the e-course section, or just shoot our team an email at team@thewealthelevator.com and we can point you in the right direction. Going into these topics a lot more in detail in this e-course. And one of the sections is the easy ways to make this process as simple as possible. Now, some of the carriers out there simply just pick up the phone. The maximum over the phone loan that you can draw from yourself is $25,000, and you can get that done in 4 to 5 minutes. When you're signing for more than that, you typically have to sign a PDF document, and then it takes maybe a week for the money to drop into your account. But it's pretty quick liquidity to get money from there. And all the carriers have their apps these days and online portals. Works pretty simple where you can get the liquidity pretty quickly. To bring this all together, you contribute maybe 100 grand into one of these policies. Step one, obviously you have to work with a licensed insurance professional. If you guys need a referral, just go to thewealthelevator.com/vendor and then put your name into the form there. Step two, you establish this policy. You have to go through some underwriting, a medical review. It's not that difficult. Most times a nurse comes out to your house, does a little medical questionnaire. You have to obviously answer it truthfully, but most times these policies, it's not really dictated too much on your health because we're not looking for the high death payouts. We're looking more for a liquidity mechanism. But yeah, certainly if you're a smoker or you're at high risk, may make this strategy a little bit less advantageous, but it's just better to go through the process and see if it makes sense for you. Once you start to fund the policy, now you have a cash value. In the beginning are when all the fees hit you. But by the 3rd to 6th year, the fees are a lot less negligible at that point as you start to hit this crossover point. And that crossover point is a way to, as an astute consumer, compare different policies from different carriers and then from different agents. Again, you don't know what the agent is charging you in terms of commissions and fees. At the end of the day, a lot of these things are commodity products, pretty much just a realtor, right? Do they want to charge you 3% or do you want to charge you 2%? At the end of the day, it's pretty much the same product. Now, I know the agents will probably disagree with me on that, but that's how a lot of the financial product world works. You take a loan from your policy, put it into a project, buy some stocks, buy some real estate. This is the name of the game when you are in the growth years. You leverage your cash value policy, and now your money is growing into places in your life insurance and also in that investment. You start to generate income from some of your investments in the long term. Maybe some deals go full cycle. And then when the money comes back to you, you put it back into your policy and maybe rinse, wash, repeat. But also life happens, right? And this is the way that people use these policies all different ways. Some people will leave 10, 20 grand of cash value in their policy for unexpected expenses to come up. I think this is a superior place to put liquidity as opposed to your under 1% bank account. And when the money is growing in here, it's growing tax free. Where when the money is growing in your bank account, it's considered ordinary income. So again, this is tax advantage. And then the idea is continue on the bend into step 5 and 6, and you have your cash value grow over time, just like a house grows in value. You continue to use it as a bucket. And then the strategy kind of changes when you start to hit end game, $4 to $5 million net worth. And you're getting to a point where you don't need to necessarily invest. You don't need to grow. And one idea, theoretical idea, is you start to pay off your policy and pay off all your loans and just have 100% or a big portion of it as cash value. And at this point, you have this pool of money. If an opportunity comes up, you can just put it down, take a loan from yourself and put it right into the investment. But you have the capacity for it to be there. Obviously, it's asset protected when it's in the policy. You know, there's a lot of other strategies, but from a legacy transfer standpoint, there's all these cool ideas that people come up with in our community where, the money's in there and you may assign the rights to your kids. What some people do who are a little bit older is they'll buy a policy on their kids, but still own it themselves. That's how they get around the whole, they're too old to acquire their own life insurance policy on themselves. Or if a lot of these policies is dictated on how much money you make, because again, that's how the death payout is dictated. What's your potential earning potential? The question is, does it make more sense to write a policy on our children who have a lower premium or ourselves because we are closer to that payout on the death benefit? Obviously, the children are going to have a longer life expectancy and are going to be in a better health rating. But the problem with that is they're going to be limited to the amount of the policy size that they're going to get. Because again, this is based off of their earning potential. And especially if they're 18, 21 years or under and they have no job, you're only going to be able to qualify for a pretty paltry sized life insurance policy, right? Like most of the people, accredited investors doing this strategy, you're dumping in $50,000 to $100,000 a year. And you're going to need to substantiate an adult salary to get that type of policy. I think it really works well if your kids are starting their jobs, and a lot of you guys have raised great kids who have professional 6-figure salaries. I think that's an ideal strategy to use them as the insured person. And you can even own it. You don't have to give it to them yet. And then now you can see where we're getting into these strategies of passing down the legacy, passing down the resources in this mechanism. For those people older than the age of 60, this is something really to look into to get on your adult children as opposed to yourself. A lot of these strategies are what family offices do. People with $100+ million, they'll do a strategy called PPLI, which works in the same way. You'll have the patriarch of the family buy a life insurance policy on the youngest person in their downline, and that person will be the insured head. Of course, they diversify, right? And then part of that too is if you have 2 working spouses, most people will do is they'll insure the female because females typically, they live longer and the actuary tables are a little bit better from that perspective. But you also got to think of it from a pragmatic standpoint. What if you don't pass away? What if your spouse passes away? Then you don't get any money, right? So to diversify that makes sense to spread it out as opposed to just put it on the female's side. So this is, again, where you talk with your agent and you find the best configuration. I think it makes sense to try and even it out, maybe put a little bit more on the female side because very slightly cost effective. that way, but it's all based off of what the earning potential of the person. But yeah, as you can see, it's a tool that can use many different ways, especially when you get halfway through this procedure, you're seeing how it becomes a big part of your financial toolkit. The problem is just, again, going back to trust. Everybody who has kids here needs to have trust. You should have got it a long time ago. This is no different. Once you have it, you're glad you have it, but it's something where it's like you perpetually procrastinate on is what we notice. But again, this is a commodity product, and the way to compare policies, you could ask your agent, hey, the policy you did for me, was it a 80-20 split? Was it a 50-50 split? How much was insurance to paid up additions? Some of these agents don't even understand that question. What I've realized, it's a very technical type of product to sell, which is why finding people has been extremely hard to do it for our more sophisticated group. What you want to ask for is the illustration, or when you're getting a new policy too, you look at the illustration, which is this kind of computerized spit out of a bunch of numbers here. But the thing to key in on is the break-even point, which is highlighted in green here. At the end of the day, the policy is growing. You're paying fees in the beginning, but that's how you measure at what point, how many years does it take to, when do you recoup that and get back to even? This is how you can compare how much more advantageous one policy is to another. Some policies that are less configured properly with maybe a 50-50 split, the break-even point would have been maybe in year 7 or 8. Usually in these policies, when you're trying to configure it with the lowest amount of fees possible, usually around year 3, 4, 5 is when you're seeing that break-even point happen. But for those of you guys who like to shop, this is the way to do it. The problem is most agents out there, even if they are doing infinite banking style policies, it's confusing, and most people don't know what to look for. This policy, by the way, is a 45-year-old male, non-tobacco smoking, where they're putting in $50,000 a year, which is our standard client out there, I would say, in their mid-40s. And then as you can see in this policy, it's like a 10 pay, right? So they're putting in money for 10 years here, $50,000 every single year. And out of that, the base premium is $4,500 a year. So again, like that's where the 10% is coming from. And then the other 90% is the paid up additions. So I believe that's the delta between the 50,000 and the base policy here. So as you can see, 90% of it is the paid up additions. So again, going back to that house analogy, this is like your annual mortgage payments, and this is the rest of it that you're putting in, about 45,000 a year that you're putting in as the sort of your extra payments to principal, which kind of goes straight to the cash value portion. So some people here are interested in the new accredited investor banking policy configurations. Now, these are a newer thing that we're doing for some clients, if it makes sense. For those people with a little bit more liquidity up front, maybe you're selling off an asset, you're selling off a home or cashing out a business, and you have $250,000 of at least a liquidity at the start, it might make sense to just flash fund the policy all in the first year or two, as opposed to doing it over a 6, 7, 8 year, or in this case, a 10-year pay. When you do it like that, you can flash fund it and then you can get to work quicker, right? You can take loans from it quicker. But it depends on your own situation. This requires you to plan ahead in the future. So it gets a little fun, right? How you configure these policies. This is where it's important to work with an experienced agent who also does these policies on their own too. A common question that comes up, are all the companies the same? Again, we'll try and work with the big carriers that are the AAA rated, been around for over 100 years, been paying the premiums. For the most part, everybody's using the top 3 or so, but it depends on some carriers are a little bit more flexible than others. I have 3 different policies with 3 different carriers. One policy, I have to make my paid up additions every 3rd year. Another one, it's like 1 out of 5. So it gets a little confusing, and I've probably made it more confusing than it needs to be for myself since I have so many. And I think that's where you need to find an agent who is non-captive. So they're not just selling XYZ insurance companies policy. They can go to what's really best for you and your situation. If your income is high one year, low the other, and your liquidity is going to be going up and down, it makes sense to go with a carrier that has a little bit more flexibility in how you feed these policies. Some people think that they're being savvy shoppers and they're finding smaller insurance companies that might have slightly better dividend rates. Instead of 4.5%, it's like 5.2%, and they think they're super smart. But I'll caution against that because some of these smaller life insurance companies are definitely not as stable as the big ones that have been around for such a long time. Like the other year, I saw somebody using a life insurance company out of Puerto Rico. It might be better terms up front, but look, this is something that I want to just sleep at night, right? To me personally, I want this to be the most stable thing in my portfolio. And then the other things I do are obviously more risky and higher return. But I just don't want to screw around with the stuff on this side. So generally, I would say just stick with the big guys. If a dividend is a little bit higher, one carry or the other, I'd just still go with the more reputable company there. But again, the agents will apply their sets of fee structures on it and then obviously configure it differently with different amounts of insurance premium percentages, as we mentioned before. So that's really where the differential from your guys' side comes from as consumers to really shop this stuff out. One thing I wanted to do was just talk about the accelerated death rider benefit. This is discussed in the book Die with Zero by Bill Perkins. He was on the podcast a couple years ago. And one of the technical things he talked about in that book was the end of life care, going to an assisted living or a SNF. Money just goes out the window. And he mentioned that it might be a good idea to insure against that risk at the end. And a lot of times these policies, you can have this be an add-on to your policy. Again, not the purpose of the whole life policy or this infinite banking or credit investor banking setup, but something to think about. And if you still want to have term life insurance as additional add-on, that's fine. But again, this is, I think, where you have that individual conversation with your life insurance agent. When you're doing the underwriting process, it's pretty quick. I've seen people get these policies done in a month and then taking a loan and then loading it into an investment or getting access to it right away. There is some income documentation when you're applying for over a $10 million policy. So some folks, they want to put in $250,000 or more a year on them and their spouse. That's usually the threshold where you're getting a policy over $10 million. And that may require additional documentation. But generally, if you're doing something that's $50,000, $100,000 a year for 6 to 10 years, it's usually pretty light on that side. The hardest thing is just scheduling your medical review. I don't know if you need to have a blood review. I think that's where you have to talk with the agent. But I think the biggest thing there, get it done as sooner. Your health isn't getting much better. A lot of it is dictated on your age. So if you're kicking it around, I would just say get started with the process and get moving with it. People take the strategy and they take it a lot of really cool places, things that I haven't really thought of. One of those, some of the people in the family office groups have found a way to triple dip it, where instead of what I was alluding to earlier was you're double dipping, right? And the double dipping is you're making money in the policy, but also your investments. But what some people have done is taken the money, put it into investments, and then getting a loan from that and then put it into the next set of investments. So you're triple dipping. And again, you're probably like, what? And that's what I was like at one time. I was like, what are these people doing? And then you introduce a little bit more risk. But if you're investing in stable assets, or in this case, I'm not super familiar with security-backed line of credits myself. I probably would only feel comfortable doing it on T-bills, for example, right? Where you can get usually 100% leverage on your T-bills because it's such a low volatility investment. And I would probably use that just for myself. That's just where my comfort zone is with paper assets. But then to get a loan from that and put it into real estate, for example. But yeah, this is the start, right? Once you start to build this policy and you get down the road and you can become sizable, multiple six figures, a lot of these strategies really open up. Some other use cases out there, upper left-hand corner. I think we talked about this, but just to sum it up, people will fund like a 6-year policy where they put $250,000 per year. They'll every year take the money out and maybe fund a deal or two, 50, 100 grand in a couple of deals. And they'll capitalize on the long-term arbitration of the rate, right? They're maybe making or paying 5% on their infinite banking policy, but making 10 to 20% accrual base at the end of the deal. The deal may not be cash flowing that much, but from our accrual base, it eventually catches up with them. Of course, investors will need to evaluate their own risk tolerance for this, but that's the concept of the growth years. When you're under a few $1,000,000 net worth, you've got to have your money working for you. And part of that is using leverage. A lot of people will use 529 plans, which I'm not a huge fan of because you're captive to the traditional sets of options out there. And the second problem is you have to use the money on educational things. Whereas when you use the infinite banking plan as your partial 529 plan, you can use the money for whatever you want. Home remodel, kids education, investment, or you can keep the money and hoard the money in your policy. You can do whatever you want with it. The ideal place for midterm liquidity and possibly even short-term liquidity. I haven't seen anybody who's paid off their monthly expenses by funding it through an IBC every single month, like how some people do that sweep strategy kind of thing with the HELOC. Certainly, if you have a $20,000 expense that comes up infrequently once or twice a year, that's where you call a loan from your infinite banking, and in a week, you get the money in your bank account and you're off and rolling. Bottom left, endgame investors with higher net worth simply just want to fund their daily expenses out of it or have the money grow at that point. When the policy gets so big, the way you get it big is by starting today, right? Or start yesterday was the best time to plant a tree. If you get $2 million of cash value here at 5%, and mind you, that's tax-free, right? Because it's not a modified endowment contract, it's life insurance. That would be 100 grand that you live off of tax-free right there. And that can be your retirement plan. And again, when the money's in there, it's off the table of litigators. It's very good asset protection. And new investors, right? Like new investors getting started, I think this is a great place to just get things ready, start to load the gun, get ready just to set this stuff up. Now you can do an accredited investor policy, what we call AIB for short, and flash fund it all in the beginning. Or you can do like the illustration called for a 10-pay, a 10-year policy, or way I personally did my policies was like a 6-7 year policy load period. That's usually a little bit more faster. However you want to do it, this is where everybody needs to decide what's best for them. And that's dictated on how much liquidity you have up front, really. But at least when the money's loaded into this thing, you're making money tax-free at around 5%. So it beats the money market out there and it's asset protected. And I think new investors who look to access home equity, which right now, the HELOC rates are really high, right? So even more now than ever, taking loans from your life insurance policy is more than likely going to be lower than that of a HELOC. And of course, this may change over time as interest rates start to come back down. But for those people who are uncomfortable with these types of new alternative investing, alternative finance strategies, they feel uneasy about the monthly interest occurring in their HELOCs or their mortgages. Whereas the cool thing with these infinite banking policies, it's not like you have to make payments to it. There's no payment schedule. The interest accrues, but as long as you fund the policy with enough that it doesn't hit a negative amount, you don't have to worry about the policy kind of caving in on each other. I might be explaining that the wrong way. Again, you have to talk to your agent about and understand this concept. But it's a pretty simple concept. I think once you grasp onto it, it's certainly important to know. But when you configure the policy with such a low amount of insurance, it actually makes it pretty simple to hit your base premiums, right? And when, now you're seeing like the huge difference between a normally configured IBC policy at 50% premiums and a non-IBC policy at 100% premiums. You may have to be paying 5 to 10 times as much money just to keep that money alive every year. Again, get a little technical here, things for people to be aware of. But as anything, you got to learn how to drive a car. You got to know where the seatbelts are. You start to understand these things pretty quickly once you get one of these policies. But the benefits are great. And I think for a lot of you guys watching this webinar, you guys are attuned to some of these alternative investing strategies, but you likely have friends or family who they'll never buy a rental property. They'll never invest in syndications or private placements. The trickiest thing that they'll do is do like an age-based index fund. I think for those people, especially people who've paid off their mortgages, to transfer their net worth into one of these very stable policies that, again, is asset protected and tax advantage might be a great idea. Again, not giving any financial advice here, right? But I think once you understand how this tool is used, multiple use cases for this and combinations. Again, this is not financial advice, folks. But if I was starting it today and just to throw a dart at the dartboard, if your net worth is $1 million and you net $60,000, $80,000 per year, which I think most of folks listening are at that level. And what that means is that's what you save. And I've always said it doesn't matter what your income is. People in our group, they make $500,000, $1 million a year. Some only make $200,000 a year. All I really care about is what you net at the end of the day. And that comes down to basic personal finance, keeping a freaking budget and not spending more than you make. And the net is really the important thing. A lot of you guys, like myself, have been very, at least I'm saying, speaking for myself, I've been pretty neurotic about saving my money over the last decade. And I have to learn to loosen up a little bit. And for what I tell folks like myself is, if you can save $50,000, $100,000 a year, you're doing really good. And I'd say enjoy and smell the flowers a little bit. But that's where in this kind of base example, if you're able to save $60,000 to $80,000, maybe take a third of that or half of that, and then use that as your 5 to 7 year commitment. Or in that, we talked about the 10-year pay, contribute that amount every year for that 10 years or so. So that might mean, just for starters, $30,000 to $50,000 a year. Maybe more if you have a big load of money, couple hundred grand lying around, either in an IRA or any other non-retirement account. If you got like $1 million of just lying around, or you got it inherited, maybe you bump that $30,000 to $50,000 up to 100 grand a year, right? Just to account for that. Of course, if you have a bigger amount, that's where you do that credit investor banking. On the next slide, I'll get into that. But you do a 90-10 policy where you minimize the fees and you max load the cash value policy. And then you just let that run. And then more than likely at that point, maybe you're getting paid more. Maybe some of your investments are panning out. And then you layer on top of that a second policy. And that's why I have so many policies, because I started small. I started smaller than what I thought I should have. And then I put another policy on top and I get another policy on top of that. So that's how you build into this strategy. I think some people, they get maybe a little bit intimidated on, I have to do a $250,000 policy per year right away. No, you just do something, get started with it, right? The idea is creating the tool, and then over the years, you start to learn how to utilize the tool. And especially when you start to get around other accredited investors also doing the strategy and utilizing it in different ways. Now, for the accredited investor banking method here, this is again for those people who have a little bit higher net worth and certainly have a little bit more of liquidity at the moment. And the reason being is accredited investor banking is a way of flash funding the beginning part of the policy, get money working faster, as opposed to just doing 50 grand every year for 10 years. In these policies, you fund the first year, and then in theory, you may be able to do one every year and layer it that way. But that's just how the use cases between the AIB case and the traditional IBC case is done in those two methods. We go into this a lot more in detail in the Infinite Banking e-course, which you guys can find at thewealthelevator.com/club. And then once you get your login there, you should have access to the e-course portal. All these sections are broken up so it's easily digestible. And then there's some screen shares of how do I take a loan? If it's your first time, go through the curriculum. And then there's more, we get into a lot more advanced case uses for those of you guys who do originate policies, the cool tips user guide section in there too. But again, I don't have a license in this. I just use this personally myself. A lot of folks in our community do this. So I thought I'd share the strategy. If you're not a part of our community, you can go to thewealthelevator.com/bank, BANK, or you can also go to accreditedinvestorbanking.com and you'll get redirected. There, you'll have to put in your email address to get access to the full e-course. But once you guys are ready, or you want to take a look at your older policies and see if it makes sense, if it's properly configured, just reach out, team@thewealthelevator.com. Remember, this is one of the parts of the trifecta I keep talking about. I certainly think for high income earners, the tax strategy is really the low hanging fruit for folks. Of course, you got to invest in things like real estate that get you a lot of passive losses to implement those strategies. We have the syndication e-course where, you learn how to do diligence and look at deals to pick the good ones. But the cool thing is infinite banking, you're literally making money in two places in the investments and the cash value policy. And this is one of those things that just separates you against your peer group that is just doing the traditional thing out there. It's not a get rich quick scheme. It takes a while, but I certainly thinks it is a lot more efficient way of getting there. It is certainly a little bit off the beaten path, which is why we say get more closer to our community. We have the mastermind group for people to join. I would certainly say that if you're investing more than $250,000, having a community around you to help learn these strategies and also look at deals together makes a lot of sense. To answer your question, what is the going rate on a policy loan today? It ranges, let's just call it like 4 to 6% there.
Thank you. Your point is that the rate today in a policy loan is obviously better than anything you can get from a HELOC or other areas. So might as well leverage that.
If we were back to 2020, 2021 days, I think the HELOCs might have been around 3%? It's usually like prime plus 1 or 2. So then it would have made more sense to pull the lazy debt equity from the HELOC. But yeah, certainly today, if you're just going by the numbers, the money is better to be here. Now we get into some of these more advanced strategies for like people buying like $1 million, $2 million plus homes. I still rent these days, but I was looking into it and I was like, what the heck are people doing? Because you can't get a mortgage for larger than 600, 700 grand. And I don't want to pay cash for it. Right. And what I've learned is like wealthy people, most of them are just trust fund kids, right? They don't really care. They don't really understand the usage of debt. But if you wanted to apply debt, it would make sense, especially in today's environment, to pay cash for it, but then take the loan on your infinite banking at that 4 or 5%, as opposed to getting a mortgage for 7, 8% these days. Or actually, for that big of a loan, it's probably like 9, 10, 11%. So a huge differential there.
And then there's the whole aspect of simple interest versus the way they compound the interest in a mortgage. And it's all back end loaded. So you're way better off with using the money from the policy loan as well.
But in this case, it's both simple interest, right? HELOC is simple interest. Just to compare apples to apples, right? The HELOC versus infinite banking loan, both simple interest.
This is great. Thank you.
So it's a tool, right? Like I think the thing that is difficult in the beginning is starting it, because who has liquidity? No one ever has liquidity. That's everybody. Best time to start was yesterday, right? And you see how it grows over the years. And if you're just doing $50,000 a year and you do that for 7 years, in theory, you'll have $350,000, $400,000, maybe even more, because it's growing and compounding in there for you. But then you have that nice little slush fund to do what you want with it. And then plus 10 years onto that, who knows how big that thing is.
And a death benefit for your heirs.
Yeah, but who cares about them, right? It's asset protected. That's the biggest thing. Think for yourself, man. But to that point, this is where some people, they like these types of strategies where they can assign it to their kids to do exactly what you're talking about, but they don't have to give it to them. But it's in a controlled substance mode. Whereas, hey, son, here's this policy. Here's how you use it. You take loans from yourself, but you got to pay yourself back, or you pay this moderate or low interest back to yourself. In a way, is a governor to reckless spending and buying Jaguars or Ferraris or Corvettes if you just give money away. Like some people have certain thing resonates with certain people or kids. Some people have said great success with giving them the reins to a policy like this. And then it teaches them in real life, hey, here's how you use debt. Here's how you pay it off. And then here's how you take this debt, you put it to something else. And yeah, there's a little risk involved in that, but it's in a controlled environment.
A really large credit card with a very large limit, but really low interest rates compared to a credit card.
Yeah. Yeah. All right. Thanks everybody for jumping on. If you guys need to run any policies, let us know. Talk to you later.